Hey everyone, welcome back to the channel. If you're a European investor, or you're thinking about starting, this video can genuinely save you a lot of money over the long term. Because many of the biggest investing mistakes Europeans make don't come from being careless or reckless. They come from following advice that simply wasn't made for us. And I know this, because when I first started investing, I made several of these mistakes myself. At the time, everything I was doing felt logical, even smart. But looking back, some of those decisions quietly cost me years of compounding. Today, I want to walk you through the biggest investing mistakes Europeans can make, and how to avoid them. The first mistake is probably the most common one: blindly following US investing advice. Most investing content online comes from the United States, and honestly, a lot of it sounds great. People talk about living off dividends, monthly income portfolios, and high-yield ETFs. It all sounds simple and attractive. But here's the problem: European tax systems are very different from the US. This means an American investor might receive dividends and reinvest them with very little tax friction. A European investor doing the exact same thing might lose 25 or 30% of that dividend immediately to taxes, before compounding even starts. So strategies that work perfectly in the US can be surprisingly inefficient in Europe. The key takeaway here is simple. Always ask yourself whether the investing advice you're following was actually designed for European investors. The second big mistake is choosing distributing ETFs in high-tax countries. This is a mistake many beginners make without realizing it. Distributing ETFs pay dividends directly to you as cash, and in many European countries, those dividends are taxed immediately. So what happens is this: you receive the dividend, but a large part of it goes straight to the tax authorities. That money is now gone. It's no longer invested and no longer compounding. Accumulating ETFs work differently. They automatically reinvest dividends inside the fund, without paying them out to you as cash. For many Europeans who don't need income right now, this allows their investments to grow more efficiently over time. The important thing to understand here is that receiving cash feels good, but cash flow is not the same as wealth creation. The third mistake is overtrading and constantly tweaking your portfolio. Many beginners believe investing means doing something all the time: buying, selling, switching ETFs, reacting to market news. But every action usually comes with a cost: transaction fees, taxes, and emotional decision-making. Even small costs can quietly add up over time, and emotional decisions often lead to buying high and selling low. Here's something many people don't like to hear: the investors who do the least often perform the best. Investing rewards patience far more than activity. Now notice something important here. None of these mistakes are about intelligence. They're not about being bad at math or not understanding markets. They're about behavior. Most investors don't fail because they don't know enough. They fail because they do too much. The fourth mistake is trying to pick individual stocks too early. Stock picking feels exciting. It feels like you're really doing investing. But for beginners, it often leads to poor diversification, emotional decisions, and unnecessary risk. When you buy individual stocks, a lot depends on just a few companies doing well. To put this into perspective, let's look at the S&P 500. In a typical year, around 40% of the companies in the S&P 500 are actually down, even though the index itself may be up. And only about 35 to 40% of companies manage to outperform the index. That means most stocks either underperform or lose money, while a relatively small group of winners drives the overall market higher. So if you're picking individual stocks as a beginner, you're essentially betting on finding that small group of winners, and statistically, the odds are not in your favor. When you invest through ETFs, on the other hand, you instantly spread your risk across hundreds or even thousands of companies. You don't need to guess which stocks will outperform. You simply own all of them. That doesn't mean individual stocks are bad. Some stocks do outperform massively. But for most beginners, ETFs are simply a better place to start. They allow you to invest, learn, and build wealth, without taking risks you don't fully understand yet. The fifth and final mistake is waiting for the perfect moment to start. This one is extremely common. People say things like, "I'll start when the market crashes. I'll start when I earn more. I'll start when I know more." But the problem is that time is one of the most powerful forces in investing. Let me give you a simple numerical example. Imagine investor A starts investing at age 25. He invests €300 per month and earns an average return of 7% per year. Investor B does the exact same thing, same amount, same return, but he waits 10 years and only starts at age 35. By age 65, Investor A ends up with roughly €750,000. Investor B ends up with around €350,000. That's a difference of about €400,000, not because Investor A was smarter, but simply because he started earlier. This is why waiting for the perfect moment is so dangerous. Time in the market matters far more than timing the market. Starting early, even imperfectly, beats waiting forever. Before we wrap up, let's quickly recap the 5 mistakes we covered. First, blindly following US investing advice. Second, choosing distributing ETFs in high-tax countries. Third, overtrading and constantly tweaking your portfolio. Fourth, trying to pick individual stocks too early. And fifth, waiting for the perfect moment to start. If you understand these mistakes and avoid them, you're already far ahead of most investors. And just like with accumulating versus distributing ETFs, small decisions today can make tens or even hundreds of thousands of euros difference over time. So before following any investing advice you see online, always remember, investing as a European is different, and understanding those differences really matters. If you found this video helpful, make sure to like, subscribe, and share it with someone who's just getting started. Thanks for watching, and I'll see you in the next one.